Guys, we are on site today in Conway, South Carolina, just outside of the Riverfront Inn. Now, in this video, I'm going to take you through the 2025 profit and loss statement so you can see how much money this property generated just last year, all of the operating expenses, as well as profit and or loss right there at the end. I'm going to show you in this deal how this property can generate just in its first year $190,000 after debt service, after financing. Yes, I'm going to take you through an entire 6-year pro forma for you to see where the property is now, what the operating expenses are, and how much profit and loss and equity you'll have left over after you finance each and every year. Now, additionally, I'm going to dive into how to read between the lines of a profit and loss statement to pick out something called seller's discretionary earnings. Essentially, I'm going to show you how a lot of times when small businesses are ran, the owners have their own kind of personal commercial expenses in the deal. And if you learn to recognize those, you can factor them back in because they may not necessarily transfer with the sale of the property. Things like interest expense or vehicles and owner's salary. As an investor, when you buy this property, you might not need to draw an owner's salary to the tune of $145,000 a year. And that could simply be return on your investment. And you probably are not going to want the vehicles that might not necessarily be needed to run the commercial business you're buying, therefore saving yourself another $20,000 to add to your bottom line. So I'm going to show you how to use seller's discretionary earnings to really read between the lines and size up a deal so you know, hey, if I'm paying this amount of money to get in this deal and the net operating income according to the profit and loss statement says this, but I'm also seeing some expenses here that could be personal, how do I factor that back in? And how much money will I actually have at the end of each year? Now, we're going to tour units. You're going to get to see the inside of units. You're going to get to see the front office. You're going to get a full walkthrough of the property. But I'm also going to take you along over to the riverfront. You're going to get to see how this property is situated at the riverfront and how it's off of one of the major commercial corridors in Conway, Myrtle Beach area, which is 501. You're going to see an extremely busy road with crazy town traffic counts. It's one of the busiest roads that head into Myrtle Beach right here just up from the Riverfront Inn. Now, guys, you got to see the investor interviews playlist. Check out the investor interview with Matt Freeze. He owns 11 oceanfront condos and spills the beans on short-term vacation rentals. Gosha Cook, she owns 24 properties, some commercial, some oceanfront condos, and is a property manager. She's a solid investor that spills the beans on her investment properties. And finally, guys, Rufia Nigro, I did get to interview an investor that owned over $10 million worth of oceanfront condos in our market. You do not want to miss those. Now, additionally, check out the Towers Motel. It's a boutique hotel in the heart of Myrtle Beach. You don't want to miss that interview with Joe. Another fun time I had on site off of Ocean Boulevard. Hit that like button, hit that subscribe button. I don't want to hold us up. Let's get into this video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits. have the highest appreciation and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. All right, guys, we're on site today at the Riverfront Inn in Conway, South Carolina. Now, as you can see, this is your little drive-up area where everybody parks and unloads their stuff and gets acquainted with the front desk. There's the rest of the unit. It is a 2-story unit, as you can see. This is your front lobby. All right, as soon as you walk in, you are going to see a nice little sitting area. We do have a front desk, and you also have a little area for breakfast. Not bad. Now, just beyond here, you can see there's the front desk. Security area. This is technically where they store towels here, and then you have a little office area back here. Not bad. And then you have a kitchen, obviously, for breakfast. Let me give you a nice little walkthrough of this. Pretty nice kitchen. Nice little setup. Plenty of room with a center island to be able to prep breakfast food. You have another little table area over here. We also have a restroom here, as you can see, and your laundry room. This is going to be a storage area. Got their internet set up here, some shelving here. And again, laundry and towels. Another little workroom back here. Now this is going to bring us back over this way. As you can see, we do right here have an ice machine and laundry. There's our stairs. There's the rest of the building. And this takes us up to the second story. And now we're right back up front. I believe Myrtle Beach commercial real estate creates wealth differently than residential real estate because value is driven by income, operations, financing, and strategy, not just comparable sales. And in a market fueled by tourism, population growth, redevelopment, and migration, investors who understand how to improve operations and position assets correctly can create value far beyond what the average buyer sees on the surface. I believe Myrtle Beach's combination of tourism, retiree migration, and residential growth creates a unique commercial real estate environment where hospitality, retail, multifamily, and mixed-use opportunities can all benefit simultaneously. Commercial real estate isn't just about buying property. It's about controlling income, leverage, tax strategy, and long-term wealth creation. Before you buy a hotel, multifamily property, retail center, development site, or mixed-use asset, let's break down the numbers the right way. Net operating income, debt structure, value add opportunities, exit strategy, and resale positioning. Call me now at 843-360-1737 and let's structure a commercial real estate deal that works for you from acquisition to exit. Guys, we're just outside of 108. This is a standard king unit. As you can see here, nice king size bed, 2 nightstands, flat screen TV, microwave, fridge, and a desk. Got an area for luggage, vanity, and of course tile flooring, restroom, tub shower combo. Nice LVP flooring in here on the floors. We're outside of unit 110. This is a standard double queen. Now, as soon as you walk in this unit, you'll notice it is much larger. Table in the corner. You have a nice AC wall unit. You've got two nice queen beds, flat screen TV here, microwave, fridge, little area for your luggage, vanity. Hi. All right. Ironing board, little place to hang clothes there. You've got a restroom, you've got tile flooring, you got a tub shower combo. Pretty straightforward, guys. LVP flooring throughout. All right, guys. Now, as you know, this place is called the Riverfront Inn because it is riverfront. Now, I'm going to walk you through the courtyard area just across from the motel. You can see they've got some tables set up. They've got some grills set up here. I can't really get you to the river this way, but I do want you to kind of see what's going on here. So just beyond this fence is the river. Don't know if I can get you up there. There's access over this way, which I'm going to probably take you down in just a minute. Don't know if I can see over this fence. We'll find out in just a minute. There's your river. Literally. Just on the other side of this fence. Looks like somebody's got a boat in the water. I believe understanding Myrtle Beach seasonality is critical because investors who know how to structure around peak season cash flow, off-season operations, and tourism demand patterns position themselves differently than those buying strictly on annual averages. I believe the strongest commercial investments in Myrtle Beach are often tied to population migration, healthcare expansion, retirement growth, tourism demand, and lifestyle-driven consumer spending. Myrtle Beach is transitioning from a purely tourism-driven market into a more diversified economic market, and commercial investors who recognize that shift early may position themselves for long-term upside. Buyers focus on the property. Smart investors focus on the deal structure, the financing, and the upside potential. Before you move forward on any commercial property, let's walk through the underwriting together. Occupancy trends, cash flow, cap rates, expense ratios, reserves, financing options, and value-add opportunities, so you understand exactly where the risk and opportunity exist. Call me now at 843-360-1737 and let's analyze your deal before you commit capital. Now, we're going to take a quick walk to the actual riverfront, and we're going to take a quick walk to 501. It is one of the busiest corridors, traffic corridors in our market. It's one of the few ways into the beach. So first we're going to cover profit and loss, and I'm going to go through some of the financial models that I've built for this property as we walk down there, so you can see just how close the riverfront is and just how close 501 is. Now, you can see on your screen profit and loss statement from 2025. We've got cash to the tune of 161. We've got credit cards to the tune of 472. We've got total room income at 634, 633, 65. You've got a gross profit there, 634, 633, 65. Now, let's look at some of the expenses when owning and operating a motel like this right here. We got advertising and marketing to the tune of $33,000. We've got bank charges, $1,300. Breakfast items, $10,000, $10,500. We've got car and truck. Now, something super cool. $20,913.41. In just a minute, I'm going to cover something with you called seller's discretionary earnings. Now, seller's discretionary earnings are basically when you read between the lines in order to find out what business expenses in the profit and loss or financial statements are actually more like personal expenses. You can subtract those expenses out and adjust that net operating income, which I'm going to get to in just a minute. That car and truck is obviously, at least in my opinion, it is a personal expense. When somebody goes to purchase this inn, the owner is going to keep the vehicles that they have, most likely, unless the vehicles were necessary to operate the business, which I highly doubt in this instance. And therefore, you can add another $20,000, $21,000, whatever that line item is in the profit and loss statement, to the bottom line of your net profit. So anyways, we're going to go through and pick out some sellers discretionary earnings items, so that way you can dice up a profit and loss statement or other financial statements, read between the lines, and find out how much money is actually sitting there in annual profits each year, should you change how the business is ran and or operated. All right, let's keep going. Credit card fees. We've got $12,767. We got a franchise PMS system for $3,355. We've got insurance for $1,859. We've got flood insurance. Excuse me. Insurance was, yeah. We got flood insurance for $1,859. Liability insurance for $887. Property insurance was $29,000. Workers' comp and employment practices $3,600. Total for insurance on this deal was $43,961. Now we've got interest paid $49,741.91. I'm going to go out on a limb here. I don't have this exact, I don't have this from the actual owner, but I'm going to go out on a limb here, and I'm going to say that, hey, I think that interest expense is part of seller's discretionary earnings, and that basically, if you ran the business differently, you probably wouldn't have to pay that interest expense, which we'll get to in just a minute. Janitorial supplies, we've got $5,368. We've got laundry machine, $3,186. We've got legal and professional services, $1,600. Linens and lodging supplies, $8,231.14. We've got office supplies and software, $2,449. Other business expenses, $433. We got payroll service at $2,100. We've got we've got taxes at $13,000. We've got wages at $194,241. Total for payroll expenses was $210,117. We've got pest services, almost $2,000. We've got property taxes, $2,623.70. I do not understand how those property taxes are that low. Don't know how that's working out. Would like to see that. Would like to understand that a little bit better. One of the immediate thoughts I had was maybe because this is located in Conway. Conway is just outside of Myrtle Beach, so maybe his property taxes are much cheaper due to the location. So you're kind of like at that point where you're, not quite deep into Conway, not quite deep into Myrtle Beach. Maybe it's zone Conway. I'd have to look, but if so, that could be why his property taxes are so cheap. And it also could represent a really nice spot in the market, because you can see back behind me all these cars on this road. So, this could represent a nice spot in the market where, hey, you get much cheaper property taxes by owning and operating a hotel or motel in this area of town. So again, that could serve as a competitive advantage when you're comparing multiple investment opportunities. If you're looking at motels in town versus motels just on the outskirts of town, obviously you might be able to do better investing in Riverfront Inn as opposed to Ocean Boulevard. You're probably going to pay a lot more taxes. So anyways, let's keep rolling. Repairs and maintenance, we've got $26,287. Salaries and wages, $25,000. Security system, $1,600. We've got taxes and licenses, $6,633. We got City of Conway tax, $6,633. We've got Horry County tax, $5,790. We've got We got a state tax, South Carolina state tax, $31,000. Total for taxes and licenses were $43,678.63. Utilities, we're looking at $30,000 for electricity. We're looking at gas, $5,387. Phone, cable, internet, we're looking at $16,000. Let's keep going. Sewer, we're looking at $13,000. Water for the city of Conway, $12,420. Total for utilities, $77,561. Total for expenses there was $586,911. That's going to leave us with a net operating income to the tune of $47,722.11. Now, in my opinion, there's a lot more money on the table in this deal, and I can't wait to break that down for you in the pro forma. Now, back behind me this way, that's the entrance to the riverfront where people bring their boats and get out on the river, which obviously borders the Riverfront Inn. I think there could be a little bit of opportunity along that riverfront possibly to really, really expand operations and dress this place up some. Now, as you can see here, this is, and as we stand out here, one of the busiest corridors traffic-wise in Myrtle Beach, going into Myrtle Beach. This is 501. Down this way, as you can see, much further on down, that is a commercial corridor. There's all kinds of little shops and stores and this and that. Going this way, that takes us into Conway. So that goes directly into Conway, and then this goes directly into Myrtle Beach. Now, let's finish this profit and loss statement, guys. We got other income on here to the tune of $27,000. I don't have a solid answer for you on what that other income is. It could be advertising. It could be a lot of things. If you are interested in finding out, send me a text message. Give me a call. It's 843-360-1737, and I'll get that question into the owner. Other expenses, net. Okay, so net other income, $27,000. So if we have, let's just kind of break this down. If we have a gross profit of $634,633, we take out the net operating income to the tune of, the total for expenses to the tune of $586,911, and then we add in other income to the tune of $27,000. We are left with a net income of $74,806.57. Now, in the pro forma statements that I'm going to show you, we're going to take into account seller's discretionary earnings, at least some of it, and you're going to see an adjusted net operating income that's well over $300,000. Yes, you just heard me correctly. All right, guys, so now we're going to head on down to the riverfront so you can check that out while we go over the financial model I built for this deal. Now, it says there, financial analysis of Riverfront Inn. Property name is Riverfront Inn. Location's Conway, South Carolina. We've got a total square footage of 21,098. Now, these are some estimates I put in place. These are not, I have not confirmed these with the owner, but from what I can tell, this is about what the deal, how it kind of plays out. You got a unit mix of a standard king. There's 25 of those units. They're roughly 325 square feet. And your rent on that, based off of last year's 2025 performance, was somewhere around $328,500 for those 25 units. Then you've got a standard double queen. You got 20 of those units. They're about 375 square feet, and your rent on those was $306,600. Your total is 45 units total here on site, about 15,625 square feet in units, and you're looking at a rent of around $635,100. Now, as we already discussed, there was other income to the tune of $27,084.47. Guys, this could be all kinds of stuff. This could be he allows people to park in his parking lot, so they pay him rent to park their trucks there overnight while they're in town. This could be advertising he lets people do on site. Could be a number of things. Other income, it's there. Operating expenses, payroll and labor, we got $235,640. Utilities, $77,561. Essentially, the difference in the profit and loss statement and what I'm going over now is I've just grouped these into bulk totals so that you don't have to, line item everything. Utilities, $77,561. Insurance and taxes, $87,639. Operations and maintenance, $57,478. Sales and admin, $55,748. Transportation, $20,913. Interest expense, $49,742. That's going to bring you to a subtotal of $584,721. And then property taxes as low as $2,624. Wow. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last-mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry because of the 20 to 22 million tourists that visit our market each year, which is the number 2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. If you're considering buying a hotel, motel, or short-term rental hospitality asset in Myrtle Beach, understanding seasonality, average daily rate, occupancy, labor costs, and operational efficiencies is critical. The difference between an average hotel investment and a great one often comes down to management strategy, operational structure, financing, and knowing where value can be created after closing. Call me now at 843-360-1737 and let's break down the numbers and identify where the real upside exists. All right, guys, here's some growth rates for the Pro Forma that I built, and that's over a 6-year span of how I predict this property will do. You got your rent growth rate at 2.5%. Other income, I've got you at 0 because we don't know what the income is, so we really can't apply a growth rate to it. Operating expenses, I've got you growing at 2%. Property tax, 1%. Salaries and wages, 1%. Vacancy, in order to keep things simple, I just didn't include vacancy in the Pro Forma. We already know what it did last year, so we know what it should do in year 0. And I really didn't factor in vacancy. Is there potential for this property to do even better? Absolutely. You better believe it. Now, I've got you at basically a 60% occupancy rate approximately for the year. All right? So there is a lot of room to improve. These numbers, based on my estimate, is about 60%. Now, investment information, holding period. You're going to hold this property for about 5 years. Your purchase price is $3 million. You got some closing costs in there to buy it. Commissions, you got to pay out some commissions. I got you at 2% of the purchase price to the brokers that do the deal, 60 grand. You got legal and accounting, probably going to pay about $10,000 to an attorney to go over everything. Due diligence, another 2 grand for inspections and stuff like that. Total closing costs, we've got you at $72,000. Working capital, I've got you at $10,000. You know, I don't think that you really need a ton of working capital to run this business. It's only 45 units. Now, your total cost of investment then is $3,082,000. In other words, it's $3 million to buy the property. Then you've got some of those other closing costs that you got to factor in. The purchase price per unit comes out to $66,667. The total cost per unit is $68,489. So on purchase price, we simply take the purchase price and divide it by 45 units, which is $3 million. For total cost, we add the purchase price to the closing costs and divide that per unit. Then you got a going in cap rate. You're at 10.35%. Essentially, we took the net operating income for the previous year and we divided it by the purchase price to get your going in cap rate. Now, as you can see, we are officially Riverfront. This is where the docks are, where they load all the jet skis and boats and all that fun stuff. I'm going to start walking back toward Riverfront Inn. All right, now we're going to cover the reversion information. So your exit cap rate, I'm predicting that the market's going to improve by about a point and the cap rate's going to drop to 9.35%. Now here's the deal. Let's just be real. Myrtle Beach is blowing up. It's the #2 vacation destination on the East Coast. We have people moving here in droves, especially baby boomers. Basically, baby boomers are retiring at $10,000 per day and they're moving to the beach. From what I can figure out, they're moving to Myrtle Beach into Florida. And out of those two places, they figured out that they get a whole lot more for their money in Myrtle Beach than they do in Florida. New construction in the Conway area is blowing up. Blowing up. There's new construction communities everywhere being built because of the increase in the size of our population from so many people relocating here. For 3 years in a row, according to U.S. News and World Report, we were the fastest growing market out of the 150 most populated markets in the entire United States. So all that being said, with so much growth and everything that's happening here, I don't believe it's hard to conceive of the idea of this property improving in value to the tune of 1 point on a cap rate. Totally doable. Now, gross sales price. I'm saying in year 6, you got to sell this thing. You should be able to sell it for $3,765,696. Now, you'll probably have about 4% transaction cost to sell it, leaving you with a net sale price of $3,615,068. Now, there is a net proceeds there of $1,665,068. Now, how did I arrive at that number for net proceeds? Net proceeds is what you're walking away with. Basically, I've got you doing an interest-only loan, and you're at a 6.5% interest rate. So as long as you finance this property based on this model, you're never really going to be paying off or building any equity. You'll always have that $3 million balance. Well, it's just that simple. All right, so what I'm saying here is, essentially, when you go to purchase this property, the bank is going to most likely require 35% down to buy this property. They're going to loan you $1,950,000. That balance isn't going to change the entire time that you own this property because it's an interest-only loan. So if you sell the property at $3,765,000, you pay off the brokers, you're left with $3.6 million. Then you got to pay that loan amount off that you haven't touched the entire time you've had it financed because it's an interest-only loan. You don't pay anything towards the principal. Then, boom, you pay off that $1.95 million. You're going to be left with $1,665,068. So long as you can sell the property for 3.7. It's just that simple and that easy. Now, you see your financing information there. Your loan amount is $1,950,000. Your loan to value ratio is 65%. You're going to put 35% down. They're going to give you the other 65%. Your interest rate is 6.5%. The amortization is interest only. You're never going to pay anything towards that principal as long as you own this property. That loan amount will stay $1,950,000 the entire time that you own this property. It's just that simple because it's an interest-only loan. Your loan fees, I'm assuming 1%. Your monthly payment is $10,563. Your annual debt service is $126,750. Again, that loan balance is going to stay at $1,950,000. I just want to make sure I explain that clearly enough. I know I've said it a few times now, but I want to make sure that you get it. If the market improves and the property appreciates and you can sell it for $3.7 million, you pay off brokers, you're left with $3.6. Now you got a loan balance of $1,950,000 on an interest-only loan that you got to pay off. When you pay that off, you will be left with $1,665,068 according to these projections. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors. You're a business owner thinking about purchasing commercial real estate for your company. The right property can reduce long-term occupancy costs, create equity, generate tax advantages, and strengthen your overall balance sheet. Before signing a lease or purchasing a property, let's compare your options and structure the deal around your long-term business goals. Call me now at 843-360-1737 and let's build a strategy that positions both your business and your real estate to grow together. All right, now this is our sources and uses of funds. Use of funds first. Guys, your purchase price is $3 million. You got closing costs to the tune of $72,000. You got working capital that you need to keep in the bank account to run this business to $10,000. So it means the total cost of investment is $3,082,000. Now, loan fees, you got $19,500. If you take into account your $3,082,000, you add in your $19,500, you are going to be left with a whopping $3,101,500 in this deal. Now, sources of funds. We've got senior debt because basically a local bank or your banker is going to be writing you the $1.95 million loan, 65% of the purchase price. There really is no junior debt. There really is no other debt in this entire deal. Now, common equity is what you're going to be putting down on the loan amount. On that $3 million, you're going to have to come up with $1,151,500 to the tune of $3,101,500 total investment, total cost of investment in this deal. So you're going to put $1 million down, but if you're cranking out $310,000 a year, which I'm going to show you in just a minute in adjusted net operating income, can't wait for you to see what that equity is after debt financing. All right, now's the moment you've been waiting for. This is your pro forma for the next 6 years. This is how I predict that the property should perform over the next 6 years. We're starting with basically what the property made last year at $634 in gross rental income. We're adding in other income to the tune of $27,000. We got a potential gross rental income then of $661,718. We didn't factor in vacancy to keep things simple for now, but yes, you could outperform the current numbers on the table. Effective gross rental income was $661,718. Now your operating expenses, property taxes, only $2,624. You've got other operating expenses, $348,648. You've got salaries and wages, $235,640. You've got a a reserve that you should keep to the tune of $6,346. So it leaves you with a total operating expenses of $593,257. Now, if you've got effective gross income of $661 and you subtract out $593,257 in net operating income, well, technically you'd be left with not so much cash, probably somewhere in the 70s, I think it is. But we've got to factor in seller's discretionary earnings, which is $241,943. Let's look through seller's discretionary earnings and understand those line items so that you understand how to size up a deal. Now, guys, this is what I want you to understand. Out of that $235,000 in salaries and wages, that line item, the owner's got a salary of at least $145,000 he's paying himself out of this hotel. Now, there was also vehicle expense on the profit and loss statement to the tune of $20,913. And there was also repairs and maintenance, which is $26,288. Guys, not every year do you need to do $26,000 worth of repairs and maintenance. Now, there was also an interest expense on the books to the tune of $49,000. The total, so long as that interest expense was essentially, not related necessarily to the commercial side of the business, to owning and operating this business, well, then you can factor that in as a personal expense. So, that might not travel or convey, that interest expense might not convey, just like that truck and vehicle expense might not convey with this property necessarily. So all these things are going to total up the owner's benefit, total owner benefit, $241,943. So if I've got a net operating income of $68,461, and then I got to factor in seller's discretionary earnings that I can add back into the deal, I can make a few changes. I don't need to drive the same vehicles that the previous owner drove. Maybe I already have my vehicle. I don't need to factor a business expense of having a vehicle as part of this business. I don't need to have a credit line that I'm using that maybe I'm doing an interest expense. I'm not saying that that's exactly what he's done here, but I am saying that if that interest expense is part of his business and is discretionary, well, we can add that back in because the new owner, won't be using it. So the whole point is this. If I've got $68,461 in net operating income and I add back in $241,943, I've got an adjusted net operating income to the tune of $310,403. Now, that annual debt service was $126,750. If I've got $310,000 in adjusted net operating income, I subtract out the annual debt service at $126,750, I am left with an equity cash flow to the tune of $183,653. That's a cash-on-cash return of 15.95% in the first year. Guys, that's absolutely stunning, in my opinion. Now, we've got basically, I've got a total cash flow and returns measured both on a leveraged and an unleveraged scenario. So if you wanted to purchase this property only with cash, then we've put in $3,082,000 into this deal, and we are getting out essentially $316, a cash flow of $316, a cash flow of $323, a cash flow of $330, a cash flow of $337, and a cash flow, including the sale of the property, of $3,959,592. Guys, that leaves us with a 13% IRR. It's absolutely stunning. And then we've got leverage using financing. That's going to cost us $1,151,500 to get into this deal because the bank's given us 65%. Then we're seeing basically $190,000 because we got to factor in annual debt service. Then we're seeing $196 in year 2, $203 year 3, $210 year 4, year 5, $1,882,000 because you got to factor the payoff of the loan balance. We've still got an IRR of 23%. Absolutely stunning. Yes, the IRR does tend to be higher when you use financing because you have less cash in the deal.